Moon Math and Capitalism 2.0. Can you tell that I named this one? We've got Joe Laluz from Bison Trails, Andy Brownberg from CoinList, Hart Lambert from UMA, and Matt Rozak from Block. Matt is probably the perfect moderator for what is going to be a very interesting intersectional panel to talk about all the new types of crypto economics, because he's got a unique perspective as a builder and an investor that has touched a little bit of everything these guys have thought about. So I'm going to hand it over to him. Enjoy, and we'll have one more session after this. Appreciate the endurance game that everybody has played so far. It's been a great day one. It's going to get even better.
Awesome. Thanks, Ryan. And great to be here. My name is Matt Rozak. I'm co-founder and chairman of Block. We build blockchain infrastructure services for protocols and developers. And it's great to be here. Although I must say this does feel like the late shift, Ryan, but at the same time, it's how crypto runs 24/7. So shout out to Ryan and the team there at Masari. Thanks for putting this together. And then for everybody attending, hope everybody's staying safe and well during these crazy days. Moon Math and Capitalism 2.0, definitely a self-criticism of terminology there, and we'll dig into that soon. But I want to go through our amazing panel today. We've got Andy Brownberg from CoinList, Joe Laluz from Bison Trails, and Hart Lambert from UMA. And I think it would be great, guys, to just go around the horn here and give a 2-minute intro, kind of your background, what you're working on these days, and kind of kick it off with a little hello.
Sure thing. Hey, everyone. My name is Andy Brownberg. I'm one of the co-founders and the president of CoinList, and we are the platform where the best digital asset companies manage their token sales and now trade digital assets as well. And we're rolling out a more advanced exchange in the coming months. So lots going on over here at CoinList. We've launched a lot of great projects over the last couple of years, from Filecoin, Blockstack, Algorand, Nervos, Solana, Celo most recently, and many more to come. And by way of background, I got into crypto back in, I guess, 2012, 2013. I was at Stanford studying math and computer science, and had a professor named Balaji Srinivasan, who a lot of people know now as the founder of Earn, formerly 21, and then Coinbase CTO, and recently left that a year or so ago. And he was our professor at the time, and convinced a bunch of us to start the Bitcoin group there. And it's actually where I met Ryan Selkis first, back in 2013, when he was at the MIT Bitcoin Club. So we've been this collaboration has been dating back a number of years now.
That's cool. I didn't know you were Balaji's pupil. That's new information.
Oh, yeah.
Great to know.
Absolutely.
Joe, go ahead.
I think we're all Balaji's pupil. Hey everyone, I'm Joe Laluz. I'm the CEO and co-founder of Bison Trails, and we're an infrastructure as a service company focused on blockchain networks. So we work with some of the world's top custodians, exchanges, funds, asset managers, and we help them participate in blockchain networks. We also work really closely with a whole bunch of incredible blockchain protocols, like a lot of the ones that Andy just mentioned, and many more. We're heavily focused on proof of stake networks, and our whole goal is to help the entire ecosystem mature and make it easier for folks to participate and build on blockchains. I got into crypto not at MIT or at Stanford. Sadly, I didn't get a chance to hang out with Balaji way back when. I'm just a huge nerd. I've been a startup founder for a long time. I've started and built a number of different tech companies in the past, and have just been completely fascinated with the technology in the space, and could not imagine working on anything other than this. And so in about 2017, my co-founder and I started working on what would eventually become Bison Trails.
Awesome. Hart, go for it.
Thanks, Matt. Yeah, my name is Hart Lambert. I'm the co-founder of a project called UMA, which stands for Universal Market Access. I tend to shorten it to UMA. So if you hear me say that, that's what I'm referring to. Today, UMA is a platform for creating synthetic tokens. What we mean by that is these are ERC20 tokens that can track anything with a price feed. So you could create a token to track synthetic gold, or to track a different cryptocurrency on Ethereum, or to track the total reserves outstanding by the Fed, if you wanted to bet on that. But since this panel is titled Moon Math and Capitalism 2.0, it's worth mentioning that what we really are under the scenes is a platform to create permissionless financial contracts, financial derivatives, financial contracts of various sorts. And we do this with an infrastructure that doesn't require any legal recourse or any basis in a legal system. We rely on economic incentives alone to compel participants to make good on the financial contracts or promises they write into those contracts. And we do that through a bunch of just basically economic designs and incentive structure designs, where we compel people to do what they say they're going to do, otherwise they lose money effectively.
Cool. And just to table set, so I've always said that blockchain tech is a generational opportunity for entrepreneurs and investors, which translates to once in a lifetime. And here we're sitting just over 10 years after Satoshi's 9-page PDF. And in some ways, we've come a long way from zero to here, but we've got a long way to go. We've seen a lot of innovation and financings and ups and downs in this space, and it still feels like we're super early. And the way I think about blockchains is these digital cooperatives that have utility rules and incentives all burned in code, and playing those levers and trying to figure out the hearts and minds of users and developers and investors, speculators, and harmonizing those is always a feat in this space. And I also love seeing the two formations coming up in the blockchain space, where you have these DeFi Legos on anything finance related, whether it's lending, et cetera, or the other Lego bricks that are forming around infrastructure, whether that's access and VPN, database, storage, compute, et cetera. And those two are kind of inextricably linked in a certain way, but they're very different from a finance standpoint and a tech infrastructure standpoint. All have different incentives in their own right. And a key component to all this stuff is capital. It's a people are like, well, crypto is used for speculation, and if you look back over the shoulder, the speculative interests fund innovation. So it's a very critical piece of the equation versus people saying, well, there's no users on this particular blockchain and it's speculators. That is a good thing. That is a phenomenal thing to get certain market participants to play into these systems and help them get the flywheel turning. So we've got a lot of surface area to cover here with Moon Math, capital formation, infrastructure, et cetera. So let's kind of kick it off here. So from mining Bitcoin back in the day to the Cambrian explosion of ICOs, the kind of modulated go-to-market with IEOs, what's really the next step, or what are some of the new formats that you guys are seeing around the corner in terms of capital formation? So I've got a team, I've got a white paper, I've got some inertia on a test net. What's a way I could finance this and take it to the next step?
Yeah, I can start there. I think we're seeing a lot of different experimentation across the board. One brief prediction I will make is that I think that we may see, in addition to new models coming out, I think we might actually see a reversion to the old. And I think people often forget that which is kind of amazing, that the first and largest and most successful cryptocurrency that exists today, Bitcoin, did not raise any money, and nor do we even know who created it. And so I do wonder if that model will see a return. We've obviously seen a couple projects take that approach in the last couple of years, but I I do wonder if we'll see some projects launch in that way. And I'm curious to watch that, because at some level the proof's in the pudding. We've seen a project do that wildly successfully, and so it'd be interesting to see more of that. I think on top of that, some of the trends that we're seeing and some of the projects that we're working with at CoinList, one of the big, I would say, building blocks, Matt, to build on what you were suggesting there is this idea of auctions, or at least the market pricing, the way that an asset goes to market. And Hart, yeah, you can certainly speak to this too, having just gone through this with UMA's, and I'd be interested to hear about that. But we've ran a couple Dutch auctions on CoinList, Solana and Celo most recently, and it's interesting to think about moving away from this model of projects raising in a way that looks a lot more like venture capital, and moving towards a much more market-driven approach and saying, great, we're going to offer this many tokens, market, you tell us what you think this asset's worth. And I do think that for teams that do go out and raise on their own, I think that'll be a really important building block going forward, because at the end of the day, these assets are really hard to price. We don't have a lot of data points so far. We don't have decades of backtesting results to inform how we're going to build these models. And so letting the market price it, I think, reduces the chance that you see really, really bad outcomes, which we've seen in the past, where a team prices a project a certain way, and then when it finally gets into market, it gets priced in a wildly different way. So, reducing the deltas there seems like a valuable thing, and I think we'll see more and more teams move towards, market pricing mechanisms as opposed to fixed price go to markets.
Yeah, and I will keep going.
No, please.
No, I was just thinking about a project that I was affiliated with called Metronome, where we did a descending price auction, and somebody spent enough gas at the end to scoop up a good chunk of it. And so every iteration, you think like, oh, a descending price auction started at 2 ETH per 1 unit, and every minute or 10 minutes or hour, price is down, and then somewhere it'll get cleared. You learn lessons, and it's like, it's hard to, and that was 2 years ago, back then, say, what are all the 100 different risks involved, or the different ways in which people could, gamify it. And I think every deal that, every project, every platform that launches, everybody winds up adding to their kind of book of knowledge on how to do it better the next time. And so I love seeing the innovation. I want to hear more about UMA from the horse's mouth. But Joe, you were going to chime in?
Actually, I think Hart was going to chime in, although
sorry.
I'd love to let him chime in. I just wanted to add one thing here to what Andy was saying, is that I think that one of the coolest innovations that we have been seeing in the last little while with projects is that they've been choosing financing paths that potentially better align with the goals of the project itself, and that's been super interesting as well. So whether it's really stable store of value, or there's not a lot of people really working to make breaking changes on the protocol itself, or it's complete moonshot, we're going to try and rebuild everything you've ever known about distributed sharded databases or data stores, you're sort of seeing folks kind of like choose funding mechanisms that align a little bit better with what their goals are. And Hart, I'm actually curious to hear what you had to say about that as well, because I know you guys have been going through something recently.
Yeah, guys, I could talk for a few hours about this stuff. I think it's a great topic and super fascinating. And again, there's so much to learn and so much to experiment with. And I know, just looking at the panel, we're all kind of finance nerds that are also market nerds, market junkies, love like learning these things. And to like Andy's point, there are new tools for price discovery that just haven't existed before, or certainly haven't existed at this kind of level, or at this low a barrier to entry. And I'm kind of obsessed, at least conceptually, with automated market makers like Uniswap or Balancer, as lowering a barrier to entry for market making and for price discovery, where traditionally before then, if you're going to have a publicly traded token or publicly traded anything, you need to employ people and machines to sit there and market make and provide liquidity all the time. And all of a sudden, there's this new concept that again, it's got some history in academics, but it's only like recently new in reality. This new concept of, oh, I can just like load some capital into this smart contract and have constant liquidity provision 24/7 for like almost zero cost. And because of that, what we tried to do is do what Andy was talking about, is use the market for price discovery around our project token, which is a governance token. And also Andy brought up this point too about you don't need to raise that much money. We raised a relatively modest seed round, built our technology, built the entire network and token in a way that was complete, and then pretty quickly put that out there to get price discovery and learn how the market, or at least attempt to get price discovery and learn how the market prices this thing, which is a very, very different financing path than, you know, a traditional startup. Yeah, I'll stop there.
I have one quick thing to add. There is kind of a point across what all of us are talking about here, is that a really interesting component of this industry is that because of this explosion of new projects and new assets, right? All of these different projects have their own native token, or many of them do. We're seeing a scale of economic experiment at a level that I think we've never seen before. And so whether or not a concept like an automated market maker, or, you know, a Dutch auction or anything else could have happened in the existing world, it's not like those concepts are, you know, specific to crypto and would never work in an arena outside of crypto. What we do have here is this fertile ground where there are tens, hundreds, thousands of economic systems being spun up all around the same time, and each experimenting with a different model, to Joe's point, that fit that specific project's needs. And so we're getting to see really quickly this iteration that I think is dramatically accelerating, you know, financial innovation and market innovation that could filter back to the non-crypto world. It could turn out that after, you know, 1,000 experiments in raising money for token projects, that Dutch auctions are by far the best way to do it, or, you know, a Metronome style auction is the best way to do it, or whatever. And we'll learn those lessons and be able to take those back to other assets as well. So I think the scale of experimentation here and the ability to work across so many different assets at once is one of the most exciting things about this space.
Yeah, I couldn't agree more. And I do want to go back on Uma, and just if you could give us the story of kind of how you got from 0 to 1 on that project, because I think it's good for the audience to hear kind of what you went through on that, because that's a real life recent example of a creative financing.
Yeah, I should back up for a second. Yeah, so background on what this project is or does. So our project has two components. We have financial contracts. We call them financial templates. The first version of this creates synthetic tokens, so tokens that track anything for the ERC20. And then we effectively have, we call it a priceless oracle. We have a design where the ultimate enforcement mechanism is a governance system, an oracle-like system that has token holders that vote to basically judge disputes in the financial contracts themselves. And the tokens behind that oracle system are what accrete value as the protocol gets used more. So we built this thing, and we're still early days in terms of actually getting usage around the protocol, but the actual project token existed, and we built it using our seed money. We raised $4 million of seed money about 2 years ago. And yeah, again, fairly capital efficient. I also kind of, to Andy's point, I don't believe you need to raise a ton of money to be able to build a lot of things here. With this project built, what we then did is we did what we might call an initial DEX offering, an initial decentralized exchange offering, where we put a portion of the project tokens and a portion of ETH into a Uniswap pool and turned it on and said, hey guys, like this is now free to trade, free for the market to trade. And we actually set the initial price of that Uniswap pool at the same price our seed investors paid for their tokens. And this this is something that I think was an experiment that we learned from. That price was too low because the price kind of went up a lot from that. And there was some relatively violent price action at the beginning that we didn't fully expect, to be totally honest. And we now have
just to click for detail. When you priced it at the same price as your seed, what was the thinking there to say, even Steven, everybody's got a fair start in a way? Was that the thought going into that?
Yeah, I mean, the other problem here, and this actually, like, if you want my personal thoughts in hindsight on how to do this better, it probably would involve a Dutch auction process. But where should we set that initial price? When you're pricing an asset, like, where are we supposed to set this initial price? That seemed like a fair starting point to us. Mm-hmm. The issue in AMM, an automated market maker style bonding curve, is that the price goes up from there. People buy, and we expected some price appreciation, but it actually appreciated pretty dramatically. And then that felt, I think some people critiqued us, and quite rightly. I think some people felt that price action that, again, we couldn't totally predict, felt a little kind of had patterns or sort of triggered some people into ICO style price action and kind of the bad things from those days. So if you want my personal opinion on how I do this again, and I don't want to get too technical into those weeds, but since you guys are kind of nerds about this stuff, I think doing an auction to set the initial price of the Uniswap pool or the automated market maker pool would actually be the most creative. That would be the experiment in how I think the next person should do this. Let's have a Dutch auction to find the clearing, to raise the ETH to set the Uniswap pool, find the clearing price, and set the initial liquidity pool at wherever that auction clears.
Yeah, super cool, and thanks for the click for detail there. I love the experimentation. Want to go to the next topic area, and Andy, this is kind of for you, and this is kind of a drive-by. I don't know how much you want to talk about STOs because they've kind of they're out on the horizon, and people have a lot of interest in it, but it's a bit of a chicken and the egg. I could probably say with at some point, people are going to be like, if you're not tokenized, I don't want to invest. It's going to flip to that point at some point. But what do you think about STOs today? You could give a quick answer here. We could dive deeper.
Yeah, it's an interesting question. So first to kind of settle the terminology, because this is one of this industry's biggest challenges. I think is getting everyone on the same page when you're trying to use a term. I think what STO, security token offering, what you're talking about there is the tokenization of, I believe, tokenization of an existing asset, something like equity or real estate or some asset that's out there, and selling that in lieu of maybe a more traditional way of raising money for that asset. So could you do an STO for CoinList equity or for a building in Manhattan or something else, and replace the equity or the ownership with a token and sell that? And I think this idea got a lot of attention. I would say kind of 2018 post kind of the main ICO hype dying down. People are looking for the next thing. And I do think that there's a lot of potential in this concept. But it suffers from, and you said this well, Matt, it suffers from a problem, little bit of a chicken and egg problem, which is that the biggest benefit to tokenizing an existing asset in my eyes is if many other assets are tokenized, preferably using the same protocol, then the assets can start to interoperate in really interesting ways. So if you've got a whole bunch of assets that are all, maybe they're ERC20 tokens, maybe they're something else, maybe they're listed on, they're built on some other network, and they're all built on the same thing, then they can interact with each other in the way that we see tokens interact. And you can start to apply DeFi concepts to tokenized assets. You can allow for all sorts of really interesting things to happen. You imagine a world where everything's on Ethereum, just for kind of ease of conversation here, and all of a sudden those things are collateral types on Compound. Well, that's interesting. Can I borrow DAI against a tokenized asset that I own? That's a cool concept. But until there are many assets all issued on the same blockchain, on the same protocol, there's not that much benefit to being the first one. And in fact, I would argue that there's a lot of pain in being the first one, because what we see from our perspective running offerings for projects, we've looked at a ton of STOs, is that investors just don't really want them right now, for the most part. And the reason is a little bit of a nuanced one. Let's talk about real estate for a second. If you're selling a tokenized real estate offering, you're selling chunks of a building represented by tokens. There's two audiences that might be interested in that, in my eyes. One is traditional real estate investors, and the second is crypto people that already invest in other token offerings and might be interested in this type of offering. I think the challenge is right now, the traditional real estate investors look at this and say, no way, I'm not touching a token. There's a million real estate opportunities for me out there that don't involve me figuring out this token craziness and wallet this, and why do I have to deal with that? Just give me a piece of paper to sign. And so they say no. And the crypto people, at least in our experience, look at this and say, well, is it going to 1000x? How much upside am I going to see here? When you tell them, well, it's got a pretty standard cap rate, and this is how this investment's going to perform, people say, it's not really what I'm in this space for. If I want to do those sorts of investments, I'm going to take out fiat, give it to someone to manage, and see that upside myself. And so what we see right now is that investors are not terribly inclined towards these. And so you're in this tough spot where STOs, security tokens in general, I think get really interesting when there's a lot of them out there and you're adding each marginal one, and that gets more and more powerful. But the cold start problem is a real one. And until that's the case, I think that it's going to be challenging. So my prediction is it's a ways out. And when it does happen, it will be someone or some group of people just deciding through sheer force of will that they're going to make it happen, and having offerings backstopped and getting that initial critical mass, productized and securitized and tokenized. And then after that point, it gets much more appealing to have an ongoing run of them. I hope that answers the question.
Yeah, no, it's good, because that was a topic of conversation a couple of years ago, and it's around the corner, but it still seems a ways off. And I do like the premise of how it then would fit into these Lego bricks of DeFi and how those would behave. That's another cool dimension there. On this explosion of proof of stake protocols, many of which were financed by you, Andy, thankfully. There's this need for new infrastructure, incentive management in terms of staking, voting, et cetera. Joe, how do you think about some of the complexities of that and helping market participants kind of digest that? You build a lot of infrastructure for that. And so there is some complexity, but then there's some kind of power in giving them the features and the tools to be able to vote, to stake, et cetera.
Yeah. Man, I have so many opinions about this STO conversation.
But you can jump in on that. I mean, yeah.
Jumping into proof of stake product. No, but I will definitely. I think there's a lot to be said in that question as well. I think. How about this? I'll even tie the two together. I think that what Andy brings up, and he's totally right, is that whether it's STOs or it's new proof of stake networks, we're still in, and honestly, even some of the stuff Hart was saying around like pricing assets, we're still in the very early days of these networks, of these assets, of these asset classes, and I don't think there's any denying that we're in those earliest stages, and that's why you have chicken and egg problems, or you have violent price volatility when you launch a new asset. Like these things are results of the experimentation, and the experimentation is a result of the hard work that folks like Andy and Hart and other folks in the crypto space are doing. I should say we all are doing, and that's the coolest thing. That's, to me, is the coolest thing that we're seeing. Like we are going to continue to see rapid innovation in the space. So like even when Hart was talking, I was thinking about asking a question about, well, like how do you price in risk and the upside of UMA into this model? And then I was like, oh, it's like too far down the road. And then Andy was talking about STOs, and I was like, oh, but like the whole thing about like real estate is access, right? Like all those folks that are investing in real estate, they have access to those deals, and it's private networks and nobody knows about them. Like I would love to be able to invest in a Manhattan building. Like, I wouldn't know where to even start to do that now, but if I could do it on CoinList, that would be pretty darn cool. And so, getting back to your question about proof of stake and infrastructure and finance and sort of digesting these concepts. So we're an infrastructure company. We sort of bridge this gap between the deep technology of mostly layer 1 proof of stake protocols, and then the sort of usage of the tokens on those protocols and the participants in the networks. And so one of the things that Aaron, my co-founder, and I started talking about and looking at really early on when we were looking at proof of stake networks was that there was this kind of combination of like deep necessity for deep tech understanding as well as deep financial or economic theory understanding that just didn't really make sense to us. It was kind of like, you don't necessarily want like your chief economist to also be like the best security engineer in the room. And that was a lot of the incentive for building the company that we started building. We looked at the ecosystem and we saw, some of the most incredible, smartest people we'd ever met, and we realized, there was a huge opportunity to help mature the infrastructure while abstracting away some of the nuances of the technology and enabling folks that want to participate in a way that is relevant or accessible to them. And so, we actually view a lot of our role as a response as a company is education to folks in the space as well. And I don't want to say that we're the only ones doing that. I actually think like lots and lots of really great companies in the space are spending tremendous amount of time educating. But it really is. It's about providing access and educating folks and helping them understand proof of stake and helping them understand what it actually means to participate in the network and why you would want to participate in that network, and that in participating you're actually helping secure the network. And that's a hard concept to sort of grok if you're looking at it as an outsider, first glance in. I would say that the thing that we spend a lot of time on is trying to understand what is the best way that we as an infrastructure provider can help a lot of these base layer protocols, or these layer 1 or layer 2 protocols scale, I should say deploy, manage, scale, and attract folks to be able to build other products and services on top of those networks. So it's definitely exciting times, but even in proof of stake networks, we're seeing a lot of experimentation. We're seeing things like synthetics and derivatives being built, and people ask me all the time, like, what do you think of this innovation? And I'm like, the innovation is awesome. I'm absolutely terrified of someone building like second order financial derivative products on like a brand new protocol, but that's like a whole other. I mean, the fact that I'm terrified of it is also amazing, right? But at the same time, I think that it's our duty as builders, all of us, our duty as builders in this space to continue to educate folks and help them understand, and hopefully we start to see some of the adoption and access from that education.
Absolutely. I'm going to segue a little bit here on token distribution models. And so early days of ICOs, even some IEOs, the token cap table, probably the token distribution table, if you will, was historically a third a team, a third community, and a third money that came in to finance and get the protocol going. That's evolved over time, where the team's percentages got squished down, the communities got squished up, and the capital providers have also been kind of squished down, where more is given to the community for adoption and incentives and developers and you name it. And we're also seeing the advent of what I'd call the small ball token offering, where it's like raising 100 or 200 million or even $1 billion. I still think we'll see many of those going forward, no question about it. But for the ebb and flow over the near term, I think the small ball token offering is going to be more of the thing, where it's not raising 100 million, it's going to be raising $1.5 million to 5 million, something like that, to get it started. And then as these projects evolve and continue to show progress, then they have a treasury they could sell from and fund, and then the flywheel, the evergreen flywheel, kind of starts to crank. What do you guys think? Just throw it out there to the crowd here. What do you guys think of the token distribution models and the way the pies have been cut historically to the way it should be? And it's obviously dependent upon the project, but how does that evolve in your mind?
I'll jump in and say that I think there's some very interesting, another nuance or dimension of this is all these new interesting ways of people earning tokens. So like liquidity mining or activity mining. And I think this is a super innovative way to get the community distribution to look more like mining or look more like something fair and actually become a tool to really develop the type of community or incentives that are going to make the network successful. So Balancer, because I'm obsessed with AMMs, Balancer is doing this with their Balancer token, where they're going to be distributing it to people to provide liquidity to Balancer pools. Compound is doing this with their Comp token, rewarding people for borrowing or depositing on their platform. We're going to do this too, but I won't chill that right now. I think that other aspect is going to be a growing tool. And frankly, this is a whole other vein of experimentation that I'm really super excited to see play out and see how this works in terms of using economic incentives to further like buttress or help even further strengthen growing your community. I then also, Matt, like fully agree that the lowball token offering is going to be the thing going forward. I frankly think that these massive token offerings, like they don't make sense as much anymore because the tools to get to market and the tools to, again, going back to being able to list on a decentralized exchange or something like that, the tools to get to market are so much more accessible that there's not really a good reason to wait until you have like $100 million offering. That sort of seems out of place.
Yeah, and I think what you said around incentives to the community, it's like airdrops are not that interesting to me. I think airdrops with conditions, refer a friend, add this node, do some activity to the network, improve the network, uplift the network. That's super cool. I'd love to see more thoughtful ways in which that's done. But what do you think about this, Andy? You see a lot of projects, you see a lot of token tables. What kind of raises an eyebrow when you see certain metrics on that?
Yeah, it's so hard to say in the abstract, and it's because every network is so different and requires such different incentives. And some networks are, their token, their circulating supply at year one is going to be their circulating supply forever. And some networks have a supply that just keeps going, and that model makes sense for them. And so it's really hard for me to compare these things and have it kind of reconcile it. I think the number one just cardinal rule that matters above all else is, just like in startups, vesting schedules, and making sure that if there are people, whether they're employees or advisors or whatever they are, just making sure that people, and we saw this with very early token projects. I think sometimes that folks started a project, got their tokens, worked for a little bit, and then said, "Why am I still here?" and walked away. And
I would say it's even more than that. I think you're spot on, and it's not necessarily a vesting like I promise you. It's vesting in code. And so what we did at Metronome, we created this token locker that would unlock it over time and is verifiable and stuff. So it's even one step further to say, it's not that I promise. It's like I can't. So totally agree. And then on proof of stake, Joe, what are you saying? Because there's some nuances there and incentives there to hold and be a staker.
Yeah. So it's we're starting to see experimentation in the incentive models, like Hart was saying, and proof of stake. There's still only, I'll call it, a handful of live proof of stake networks. So they're still in the early phases of experimentation as well. But essentially, folks that are helping bootstrap, secure, validate, and transmit messages on the network are, in a lot of ways, either protecting against dilution by receiving additional reward tokens, or receiving tokens for doing that. I think one of the issues that we saw previously, and this is to both what Andy and Art were saying, is that like projects would wait until they had this exit velocity before raising and assuming the price that they were doing an ICO at or something like that was going to be the end price. And now I think a lot of token projects and protocol founders are looking at that and saying, like, actually, we can show progress. We can create things like vesting schedules. We can create things like token lockers using smart contracts to do that, and it helps align the incentives of the folks in the ecosystem. I do think, for what it's worth, maybe it's the capitalist in me or the economist in me, I do think it is important to incentivize both capital and teams in the early stages to see outsized value for taking the risk, right? You have to price risk into the assets themselves. And I do think that's an important thing that we can't forget, right? You can't, we can't have both like infinite liquidity and availability of an asset as well as, fair price with risk at the exact same time. So, I think we're going to see a lot of these proof of stake protocols, and with ETH2, on the horizon, we're going to see some really interesting larger scale experimentation as well.
Yeah, totally agree.
We got Ryan joining.
Oh, sorry.
Sorry to interrupt, Ryan.
Are we bothering you?
No, just a little light reading. Sorry. No, I didn't mean to interrupt.
Oh, good to see you. Are we at the top of the hour, or are we good here?
We are not at the top of the hour, but we're at the top of the session because it's a 40-minute panel, and we've got CC and Sam Bankman-Fried on deck. If you want to finish with 15 seconds, since I distracted you, I cut you off. Fire away.
This is great. We'll get warmed up for CZ and Sam here, but I'll just say thanks to the panelists for sharing their thoughts and joining us here. And I'm sure they could look you guys up and find you online and get connected. So thanks again, everybody.
Thank you.
Thanks, everyone.
Thanks, Ryan.
Stay safe, guys.
Thank you, Ryan. Cheers.
Everybody.